So for investing business 3502, pardon, this is an examination of top-down investing styles or approaches where we'll scan the entire world for fast-growing economies, sectors, and then look at companies below that. So again, because we're in Canada, which is 2% of the entire world's securities markets, it's prudent for us to be able to and to look to invest outside of Canada. So top-down investing. Especially if we were in the United States, we would just look through sectors in the United States and probably think the US economy is sufficient. As Canadian investors, and depending on our level of risk aversity, we can look anywhere in the world. Okay, so where to start? Well, one area to start with is GDP growth for the world. This site, statisticstimes.com, has a menu that brings us to economies, countries by GDP growth rate, and 2014, 2015. Imagining, though, we could find the more recent numbers. Drilling down in this, Syria, nope, not doing that. Ethiopia, not so likely. Turkmenistan, Congo, Myanmar, Papua New Guinea. No, these are fringe economies. But then we get down to a more interesting section. China was ranked number 16 with 6.9% growth rate. India at 7.36. So this is another view. This is from tradingeconomics.com, also a very good source, and we can sort these again by annual GDP growth rates. But note, there's great volatility to this. Also, it doesn't order as well to find, for example, China and India. So China here, and let's go back up to see which columns these are. Organized by countries then. China, 6.7% last GDP growth rate. Quite good. Compare that with, sorry for skimming so quickly, the United States, 2.9, very moderate. Compare that with, where we find India, 8.2. That would be interesting. So we might wish to look more at China and India than the United States for our top-down analysis, just starting with the GDP growth rates. Okay, that's one of the steps we want to do as top-down analysis. Something else that we could confirm, again from charts. This is also trading economics. This gives us China's inflation rate through 2018. So again, on this metric, 2.3, 2.4%, 2.1%, not over 3 in the last year. So China would be quite attractive based on that. Now, another, again, top-down consideration, what's the foreign currency doing? So this site, visiting XE again, gives us Chinese yuan, renminbi to US dollars, and we see it's come off from 16 to 14.5 cents in the value of one yuan to a US dollar. So it's certainly dropping in value. Now, back to our other discussion, if we're fundamental and value investors, this might be very attractive. If we're momentum growth investors, this would be relatively unattractive because our downtrend in this is quite obviously sharp and has been continuing for 4 months. We should all know behind this is the growing trade war between China and the United States. But if we're fairly risk-seeking investors and we are not firmly in either value or momentum camps, we could take this a little bit further. Okay, so China passes, strong GDP growth rate, inflation rates quite under control, the currency has come off, which might make assets value very attractive. However, not far from our imaginations, let's expect that we know nothing about the Chinese economy. Okay, well, another then level of investment or selection that we would do is go through different screens to ask what's good in China. This is, pardon again if I scroll up, hope that's not discoordinating. This is the World Economic Forum, facts about China's economy. So this article would be very interesting to skim through things that we should know about China's economy. China has lifted hundreds of millions out of poverty. We know that. That's not going to influence our investment decision. China is a world's manufacturing hub. We know that. That's nothing surprising. China's GDP has slowed. Cause for some additional thought. If we read through this, it'll say China's going through an economic transformation with less emphasis on infrastructure building, possibly less emphasis on manufacturing or heavy industry, moving toward lighter industry, and as this says now, what's called tertiary economy, services. Okay, so this starts to get very interesting for us. Private sector companies are 2/3 to 3/4 of China GDP. Interesting. Tertiary sector, which is services, make up more than 80% of economic profits. And skimming a bit further, among the fastest growing sectors in this economy, reading right here, are healthcare, technology, education, and entertainment, which are gaining in importance. Now that's very, very illuminating. Okay, let's go back to our stock screening tool. And I'll reset this and start at the beginning. So using the FinViz then stock screener, everything's been reset, so it's quite open. But let's immediately go to China, a top-down methodology. Let's, for a sector, consider healthcare, which the World Economic Forum is saying is going to be growing in China. I can't say that I'm a specialist in healthcare, so that's a fairly good start. This gives us 9 different companies that we could invest in now, and we can sort these as our screen does. Return on assets, this first company has 15% return on assets, 17% return on equity, looks quite good. Okay, let's investigate further using our stock screen now. Whatever this is, Shineko, healthcare drug-related company in China, ooh, interesting. It's come down from 260 to 92 in less than a year. So again, this would be discarded according to our momentum and growth philosophies, but it might be very, very interesting if we're fundamental value investors. So we have a number of things in play here. The Chinese currency has come off about 10%. This particular company is off by 2/3, which might make it attractive for fundamental value investors. Now we would pour through the company statistics and compare it to the industry. So it gives us, let's review the methodology. We can scan the world to see where there are opportunities at a very high level. India and China appear very attractive. We then ask, or research, well, which sectors would be most attractive in China? And we learn that there's a very, very large rotation on in that market, moving away from infrastructure and heavy industry toward the service industries. That's given to us by the World Economic Forum. Then we can use our FinVez tool to investigate, for example, healthcare sector. And that brings up this TYHT, trades on NASDAQ, and the statistics that it gives us. So we also then can and should evaluate this according to both our fundamental and momentum approach. On a chart pattern, it's not attractive at all, possibly a short sale. But if we look more deeply at this, we read through the company's information, we learn a bit more about the sector, perhaps we would like this according to fundamental and value vesting approach. However, it's the selection starts here with top down and takes us through country, sector, and then company selections. So, interesting.